Good morning, everybody. It is Thursday, September 8th, 2022, and I'm getting back to doing the macro dashes articles now that summer is basically over. I know that because despite it being around 80 degrees, our condo complex is deciding to close the pool early this year because they're saying it costs too much money, which is baloney. I saw the utility bills. It's literally like $80 a week to keep it open. So in any case, I don't get to go swimming, which means I have more time to write. I think that's how it works. I wrote about how the S&P 500 will double bottom or worse and why I think that will happen. What are the main reasons? Well, first off, I just need you to really understand that the narratives that are out there about inflation are mostly wrong unless they center around energy. We know from all the empirical evidence that energy is the heart of inflation. So avoid buying into all of these other narratives that really don't add up to as much as energy does when it comes to thinking about inflation. Now, the central banks, and I watched Christine Lagarde this morning and Jerome Powell, are all talking very hawkish about how they're going to tighten up and kill inflation. Here's the problem. Tightening up on the monetary side does not improve the inflation situation if it's driven primarily by energy, which it is. All they can do is kill aggregate demand, or in other words, cause a recession. In Europe, it looks like this is imminent. Europe's economy is slowing down so fast that it's kind of off the charts. So what will happen if the Federal Reserve and the ECB continue to tighten? I think it would be a much greater policy error than the one that people talk about with them staying looser for longer after COVID. I believe that them staying looser for longer after COVID enabled a lot of corporations to be able to fund their plans for expanding supply chains, for becoming more efficient, and for moving towards cleaner energy. By tightening up, the central banks could stifle that progress. And if they stifle that progress on supply chains and becoming more efficient and moving towards clean energy, we could see stagflation. It's something that I've been warning about since 2017 when I could see it on the horizon with any sorts of policy errors or major events like war. I talked about war all the way back in 2017. We got a war. It was not the one that I thought it would be. Doesn't mean that we won't get the one that I thought it would be, which was based on Iran, but we did get Russia invading the Ukraine. And now we have China saber rattling about Taiwan. So the energy picture and the supply chain pictures, which are heavily influenced by OPEC and Russia and China, are putting a lot of pressure on the Western democracies. Now, will they crack the Western democracies? I don't think so, but you never know. They could force us to act really, really stupidly, and we could make things worse. I think the reality is that we usually don't go all the way over the edge. Although maybe this would be the one that cracks things. I don't think so, but again, maybe it would. If I'm right, and if President Biden is being as successful as I think he is with the last three bills, which had to do with semiconductors and energy and reducing inflation through various financial measures, then I think what happens here about a year from now, because I do think that inflation is going to be sticky in the next year. It's the long end of my time frame that I identified in an article about a year ago. I said inflation would last for about a year or two, and it looks like we're going to be closer to 2, which is unfortunate, but it's the way that it is. Coming out of this inflation, we're going to see the great divergence that I've talked about. And the fourth industrial revolution is going to make companies more efficient, and clean energy is going to reduce the amount of control on inflation that OPEC and Russia and China have. It's going to take a few years. I just took a look at something from McKinsey, and they are saying that fossil fuel dependence peaks in 2025. Now, that's a year or two earlier than I said. I've been telling you since 2020 that fossil fuels would peak demand would be 2026 or 2027, with oil turning definitively over by 2030. So there's a range. But in the next several years, regardless of whether it's the short end or the long end, OPEC is going to lose a lot of its pricing power on energy, and enough supply chains will have moved that China will have less influence on the global economy. And I think that President Putin, little Vladdy as I call him, probably ends up dead. Maybe he's exiled, maybe he's on house arrest for the rest of his life. But I don't think President Putin is in power much longer. This is based on historical observations that usually the bad guys up against stronger good guys with internal resistance and populations who, when they economically suffer a revolt, usually end up getting rid of the bad guys. And Putin's popularity has plummeted in Russia since the Ukrainian invasion. And Gary Kasparov is suggesting that there is already a slow-moving coup against him. If that's true, and I believe that it is, then we have some big positive catalysts coming if we don't end the world first. Now, seeing as we haven't ended the world in any of the prior horrible things that have hit us, and that decade over decade, things have always gotten better since the Dark Ages, and that's true. Things have always gotten better decade over decade. There's been a couple of flat decades here and there, century to century, but in general, things get better and better and better. And it's because everybody just wants to be happy and healthy and feel like they have some economic control over their lives, the ability to give their children a better life. And that just keeps happening generation to generation to generation. Every statistic out there supports that. More people educated, less people hungry, less people unhealthy, fewer troops on the ground, which only ticked up recently, and it's probably temporary. So when we take a look at the economy, and we take a look at the stock market, we should ask ourselves as investors, should we grab on the fear or should we be looking for the opportunities? Now, about 9 months ago and 2.5 years ago, I said it was a good time to be afraid. I think in the very, very short term, there's a fear trade coming, and that'll be followed by a greed holding period. What do I mean? I mean that we haven't priced in the risk of recession yet, and we need to do that because earnings are going to come down on this energy inflation and the central banks tightening. But remember, as Jerome Powell has already done before, it is very easy for the central banks to back off. Very easy. In the space of a month, they can go from hawkish to dovish. And I suspect with labor tight and what we know about the future, which is that destiny is in the demographics and in the technology. So the article I've told you I'm writing is that demographics and robots are destiny. At some point in the not too distant future, and it's already started, the wave has already started. The pebbles have been thrown in the ocean. And pretty soon it'll be boulders and mountains creating bigger waves. And these waves will be manufacturing and construction being more and more handled by robots, and management tasks will more and more be handled by AI. And that's why at the CES 2020 that I've talked to you about dozens of times, one of the quotes that stood out to me was that the biggest risk on employment was that middle management would have to get gutted, because what 5 middle managers could do in the future, it'll be 1 or 2 middle managers with really good AI, software as a service, powered by machine learning. So keep your eye on 3 and 4 and 5 years out, because what happens in the next year or two is just an opportunity. And while it will get painful, probably, we know that the best hedge that you can have is extra cash in your pocket. Think about the times that you've seen a piece of property that you've wanted, you just didn't have a way to finance it. So you didn't have the downstroke. You didn't have the down payment. If your portfolios are at the cash levels that I've suggested, in those ranges that I post every month, and we're at the high end of our ranges right now. If you're holding excess cash, you're collecting the 1% on it or whatever it is you can get. You're writing some cash secured puts on some of the small and mid caps that have been giving us really good premiums to buy at lower prices, then you are probably in a great position to buy the end of this bear market. And we are closer to the end than we are the beginning. My forecast at the start of the year was what? That this year would look a lot like 2018. Is that not exactly what we are seeing? Early year pressure, middle of the year rebound, and going into an end of the year that looks like it's going to be pressured again. So let's walk through this article a little bit, just so we completely understand what I've written. So Powell does have a tough job. Why? Because normally the speed at which the economy grows is directly proportional to the looseness or tightness of the monetary situation. And this is an unusual situation where fiscal things are having more of an impact. It's not so much the money supply or the interest rate or the broader liquidity in the bond markets. We are getting inflation from energy. How do we know? Pretty easy. I've showed you this chart before. This is from the Bureau of Labor Statistics. This has actually come down just a shade at the start of the year. But energy is the key driver to inflation. Nothing's even close. And remember, energy impacts food and manufacturing. So the once removed or twice removed impact of energy on other things that contribute to inflation based on the formula that's used is really the energy is impacting a little bit more than half of all the inflationary pressure. Look at what inflation is, less food and energy. It's about 5% and coming down rapidly. It was around 8% earlier in the year. Here's another way to visualize this from trading economics. This is the impact of energy on inflation. We are way outside the historical range. Normally, it's a small impact. As you can see, right before the financial crisis, it spiked twice. We got away with one here. It spiked here before the financial crisis, got the big downturn. And in fact, you got the big downturn here. We just didn't feel it because we were still doing the real estate boom with the hot money. The energy also got expensive right before the dot-com crash. So what would we expect? I mean, this is a pretty regular heartbeat, isn't it? Or an irregular heartbeat. I don't know. The impact of energy has to come down. And there's only two ways that can happen. Either OPEC has to produce more energy sooner, or the United States and Europe will produce more energy later. The United States has already promised another 1 million barrels of oil to the market around New Year's. We know that's already happening when we look at the EIA statistics, is that we're well on our way to that. Canada, 600,000 more barrels coming. And now the Inflation Reduction Act, which people make fun of, but if we know that energy is the primary influencer of inflation right now, and the Inflation Reduction Act was very heavily aimed towards creating more clean energy, what does that mean? It just means that there's a timeline that we have to understand. We're going to have record solar installations this year, and it's going to be broken next year. It's going to be broken the year after that. And it probably is going to have record-breaking years through the end of the decade. Solar energy used to be 20 to 30% of the alternative energy mix about a decade ago, and now it's going over 60%, headed towards 70 to 80%. What is suffering? Nothing really. Wind is still growing. Hydroelectric is still stable, actually growing just a little bit. So 2, 3, 4, 5 years out, OPEC's influence just keeps decreasing. Now, can Russia continue on the path that it's going economically? Not if it wants to avoid a depression. Because while Asia, China in particular, are going to soak up a lot of their oil and gas supplies, it will still be less than what they were selling when they were still selling to Europe. And if Lil Vladdy exit stage left or right, whatever, or down into the ground, don't you think that the next government of Russia will try to be very nice to Europe on natural gas, especially since EVs are going to cut into oil demand? So we're in a very temporary situation, which is transitory in nature, but transitory, as I talked about a year ago, can take a couple of years. And we're basically at the end of the first year. So while inflation pressures will start to fall pretty dramatically here in the next quarter or two, it won't probably be comfortable until about a year from now, maybe a little longer. By then, we will have added more alternative energy to the mix in Europe, Japan, and the United States. And this great divergence will be very much in full effect as technology and clean energy drive the fastest growing parts of the economy. So while the Fed is tight right now, it's just because they don't want to see inflation get out of control. They're waiting to see progress on the energy and on the supply chains. And neither one of those things can happen overnight. It takes time to build things and connect things. So we're trying to get through a time period, probably for about the next year, so that we have more control over energy and supply chains. We take the power away from OPEC, Russia, and China. It's inevitable if the world doesn't end. It's pretty much that simple when you come right down to it. So when you get lost in the narrative of the day, the headline, the screamer, whatever, take a step back and just say, you know what? As our corporations become less energy intensive because they're using better technology, as buildings all over the country get built or retrofitted or rehabbed to be more energy efficient, as we add clean energy, as jobs shift to support the fourth industrial revolution, or with the support of the fourth industrial revolution, really both. It takes time for people to train on jobs and get educated. Things look really, really bright just a couple years out. Now, the stock market is a forward-looking animal usually, except when it's looking backwards. At some point, again, eventually the market looks ahead and says, oh, looks like the next couple of quarters could be rough. And it will price in a recession at some point. And we know from what Federal Reserve officials said this spring and last winter is that they want to see the stock market lower for a while. They want to see price to earnings ratios. They want to see everything more normal. And to an extent, interest rates going up is just a normalization. But we know that slow growth forever is a thing because of the demographics. And the robots are going to take a while to get here. So during this transition period over the next however many years it's going to be, from wherever the bottom is, we're going to see some pretty big gains in productivity at the workplace, in energy intensity, in clean energy supply. And we have to get in front of those things. I've told you a story before about the best advice my grandfather gave me about money. He said, Kirk, what do you want to do in college? I said, I don't know. He said, well, whatever you do, lay down in front of the baby boomers because they'll make you rich. Well, here we are 30 some odd years later, and that worked out. Providing services and products to the baby boomers was really wealth generating for a lot of people. So what's the advice today? Lay down in front of who? The millennials. The millennials are a bigger generation than the boomers now, and they're just entering their peak earning and spending years, just a couple years into it. They're probably in the second inning. Tom Lee over FS Insights talks about this. So if you want to be a really good investor, invest with the things that the millennials are driving. That's fourth industrial revolution, the shifts in where people live, the immense support for clean energy, and how they spend their money more on things like travel and experiences than having a lot of toys, which we have both at the business level and the individual level realized, why do I need 2 jet skis when I can go to where the water is and rent them for $100 a day or $200 a day? I never have to deal with that jet ski again. I don't have to spend the $6,000, $7,000, $8,000 to buy it. I don't have to take care of it. So this is where things are going. So I want you to read this article. Understand that Europe is where the biggest risk probably is, and that if we get contagion, if we get new lows in the stock market, it's probably because Europe is spreading a recession. We have all kinds of news about what's going on already. German companies have actually shut down temporarily to save money on energy. When the equation gets like that, it's awfully tough. Pretty interesting Twitter feeds out there too, tracking what people's energy costs are in Europe. But again, they're way ahead of us on clean energy. You know that Germany gets 40% of its energy from clean sources, and that's headed towards 80%. And at some point, Russia says, Vladdy's gone. You want our gas again? So these are all temporary problems. Now, when we take a look at earnings coming up, there are a lot of people who are talking about earnings being high, but some of the smarter people out there are talking about earnings falling short, which is exactly what I've told you. So we need to be very aware that earnings probably are not going to be what the consensus is suggesting. This is Yardeni right here. Yardeni is way below what the consensus is, and I agree with him. I told you at the start of the year, I expected that earnings would come down in the fourth quarter, and here we are a month away from those. So as those earnings come down, as the revisions occur, that's probably when the stock market, has their hiccup, especially if we've gotten 75 more basis points out of the Fed. So, all right, technical analysis. Shooter is saying, in this range for the S&P 500, unless it gets worse, which case it could drop down to around 300. I'm basically saying the same thing. I mean, our ranges are almost identical, and we came up when we found them different ways. And this is the chart that I want you to think about. This is the monthly chart on relative strength index. Every time it got overbought, got a bear market or a very choppy sideways period. So here we are about to be a bear market again, probably. And when the prices get down in here somewhere, or maybe, it's a really bad recession and it gets down here, it doesn't happen often, but probably a price in here is what I would guess. I think we're going to be worse than this middle range. So I think we're going to approach the 30 line. Do we go through it a little, or are we a little short? Hard to know. But as relative strength index gets down in here, you have to be a buyer of the large caps that you actually want. So we know that there is an article I wrote about which large caps I am looking at. I kind of get a shortcut here. At certain prices, I want all these stocks. I'll probably end up with QQQ instead of some of the larger companies, but make sure you read this article too. All right, going to cut it short. I got news that Queen Elizabeth has died. Thoughts and prayers out to the family, and heartfelt condolences to the English. All right, everybody have a great day. Look for the fear when it comes, and then be a buyer.